I think the long-term story is about adoption. So the more people that own it and the more institutions that own it, that keeps driving up the structural floor for the price. There are plenty of people that would buy Bitcoin, no matter what it does in terms of price. And so when you hear about things like exchanges being hacked, that's not Bitcoin itself being hacked. Those are custodians holding it. Bitcoin really has stood the test of time in terms of being a very simple code base and a very hard form of money. And so for people that don't mind volatility, I find the probability of it going to zero pretty low.
So hi everyone, we are in for a very special treat today. We have Lynn Alden, founder of Lynn Alden Strategies, and in my opinion, one of the biggest voices in Bitcoin and the cryptocurrency space right now. Lynn, how are you?
I'm good. Thanks for having me.
What made it click for you? What did you see that, hey, there's really something in Bitcoin that this is the future? What did you see in it initially that you were willing also to deploy capital towards it?
Probably the network effects. So the question of what separates Bitcoin from other cryptocurrencies, because when I initially covered cryptocurrencies years ago, my biggest issue was, okay, so Bitcoin's neat, it's got a hard cap of supply, but anyone can fork the protocol, make their own version. Someone can come along and copy it and change the rules a little bit, make their own version. And so my concern was that if Bitcoin or another big cryptocurrency doesn't capture most of the market share, then any capital that goes into space could become very diluted among multiple projects. We tend to see that happen during bull runs. They have what's called alt season, where capital starts pouring into some of these lower quality projects. And then usually in the bear markets, it goes back to Bitcoin. But my question was long term, what's kind of preventing that from diluting the industry? And when I did more research on it, I basically determined that Bitcoin probably has reached a critical mass of network effects. And if that's the case, they can accumulate a lot of long-term value, while these other protocols, don't really play much heed to it. And so, from my perspective, there are only two protocols that have kind of a meaningful network effect, and those would be Bitcoin and Ethereum, and those are quite different. And so we don't really see necessarily a lot of competition there, although they do have some overlapping areas of competition.
You posted a very, very interesting statement right there, Bitcoin and Ethereum. And there's a lot of talk right now of Ethereum flipping Bitcoin, especially right now that they're trying to treat their scalability issues. And with ETH 2.0 coming in the next few quarters, proof of stake might address all of that. So are you in the school of thought that, okay, they're the two biggest, but eventually ETH could possibly overtake Bitcoin as well?
I mean, anything is possible. It's certainly possible. It would have to outperform by quite a bit in order to catch up with Bitcoin's market cap. The challenge that I see is I actually view this period between now and whenever Ethereum 2.0 is launched to actually be the bullish part for Ethereum, because they've kind of created a supply shortage. And so the way that works is, right now they rolled out the Ethereum 2 beacon chain, which means that it's essentially a smart contract that people can put their ETH to and start staking it, but they can't withdraw that ETH. It's stuck in there until they do the Ethereum 2.0 transition. And so that's basically a supply sink. It's turning liquid supply into illiquid supply at the same time as they introduce that EIP 1559 change, which results in less supply or potentially even a slow destruction of existing supply. And so that combination is actually pretty bullish for price over, say, the next 6 to 9 months. But then, ironically, it could be like a sell the news event, because buy the rumor, sell the news. Because when they actually launch Ethereum 2.0, all those liquid coins would be able to be sold, and so we don't know how that's going to affect the market. And so, I have long-term concerns or questions about Ethereum because I don't view it as decentralized or rock solid secure as Bitcoin is trying to solve more problems and be more things. And so I view Ethereum more like an equity where I'm analyzing, say, the main developers, I'm analyzing their business plan, and I'm kind of viewing it like that. And more broadly, proof of stake actually has a lot of equity-like components, right? So when we think of shares or a company, you get voting rights based on your ownership stake of the company, which is how it's essentially a proof of stake model. And so, tokens that go on that route, I view more as like an equity. So Ethereum's kind of like a partially decentralized operating system, like Microsoft, for example. And so I treat it like that, which is somewhat how different than how I treat Bitcoin, which is as money. So it's a more kind of rock solid decentralization, and it's more simple by design, and that has pros and cons to it.
We mentioned about also the functionality of Ethereum. I know for Bitcoin they're pushing layer two solutions, Lightning Network, etc. Do you think it's something that will be good enough also that there can be a lot of things built on top of Bitcoin, that it doesn't just become a medium of exchange or a store of value, that there will be more items that could be done off of it as well that could entail more value to people who would see it also as an asset?
Potentially, yes. And so, I mean, first I would take a step back and I would say that storing value and transmitting value that no one can block is already extremely valuable. So if it only ever does
Mm,
that, that's already a multi-trillion-dollar long-term opportunity.
mm,
Um, and so, for example, if you look at gold, but based on estimates for how much exists in the world, already mined, multiplied by its price, the estimated market capitalization is somewhere around $12 trillion. And that's purely as a store of value at this point. It's not really good for medium of exchange. Whereas Bitcoin has store of value properties, but then also has certain medium of exchange properties, right? So you don't want to use it on the base layer to buy coffee, but you can do that with a secondary layer, and it's ideal for international payments, permissionless payments, and so it's already potentially a larger addressable market than gold. Then when you add things like, for example, you know, on the Lightning Network, you can have, like we're seeing Impervious AI. That's a company that is actually using the fact that, Bitcoin doesn't just transfer value, it can transfer data. And so you can make a distributed VPN, basically, decentralized video sharing, data sharing. And so that's actually some neat applications of Bitcoin. And we also see Sphinx Chat, for example, which is a social network built on top of Lightning. And so those types of applications could provide additional value. We've also seen some DeFi protocols launch on Bitcoin, right? So obviously they came later than on Ethereum. They don't have large network effects and liquidity yet, but it remains to be seen how they'll develop. So I would say that already the addressable market of Bitcoin is large, and then we have some of these other options as well.
When you saw Bitcoin as something that had large network effects, for the benefit of people watching this, at what year did you actually start getting in, and was its price at that time relevant to you investing? The reason why I'm asking this is people right now are saying that Bitcoin is at 40 plus thousand. It may not be too early for me anymore. I'll just wait for it to go lower. What was your frame of mind at that point when you started?
Yeah, it's a really good question. So when I analyzed Bitcoin, I heard about it. I looked into it many, many years ago. But the first time that I wrote about it publicly and really took a look at it was 2017, and it was
Mm,
during that large bull run. And from that point, I looked at it when it was about, say, $7,000, and it was actually going up so quickly that when I started writing the article, it was like $6,500. And by the time I finished the article, like a week later, it was like 8,000. So we'll call it $7,000. And so I was analyzing it, and it had already had a very big run up.
mm,
And there were a bunch of other questions, like it was splitting Bitcoin Cash and Bitcoin. We were seeing very strong price action out of Ethereum. Basically, we're seeing lots of different, distributed, protocols kind of competing. Um, and so I was concerned about a couple of things. One was the big price run up. It looked too euphoric and expensive to me. And two, like I said before, I was worried about the network effect. So what makes one protocol kind of more durable than another? So I kind of passed on it. And of course, we had a
mm,
blow off top. We went all the way up to 20,000. And then it fell, and it eventually crashed as low as, like 3,500 in the long run. So it was actually, it kind of consolidated in price for over 2 years, for like 2.5 years from that point. So it was actually a reasonable kind of decision to pass on it then. But during that time, I kept watching it. And so we saw, for example, that the market sorted out between Bitcoin and Bitcoin Cash. The market basically answered that question of what's more important, the smaller block size or the larger transaction throughput. And the market preferred that smaller block size of the original Bitcoin. We also saw, institutional grade custodian solutions come out, right? So we saw more companies built around this space. And so when I saw Bitcoin have price weakness in the very beginning of 2020, during the COVID crash, so March, around that time, I actually bought into Bitcoin in April of 2020, ironically at around 7,000. So the same price that I analyzed it 2.5 years later, but I considered it de-risked because at that point I had a long consolidation. It answered some of my questions, and so I got in there. And it's funny because most people, when they talk about their first time buying Bitcoin, they always feel like they're too late. They always feel like it's most of the price actions behind them, and that can be true in the near term. I mean, Bitcoin's had these bubbles, in say 2014, 2017, and they can sometimes take years to recover. But so I would say for anyone buying Bitcoin with a 5-year view, and just if you kind of commit to holding it for 5 years or more as whatever percentage of your capital you feel comfortable with, something like that, I still consider there to be a lot of upside for Bitcoin. Like we discussed before, Bitcoin right now is something like 10% the size of gold as a market capitalization, less than that, probably like 8%. And so, even if Bitcoin becomes half the size of gold's market cap, that could be a 5 or 6-fold increase from here over a multi-year period. And so I actually still have a very long-term favorable view on Bitcoin. I mean, some estimates showed that, somewhere over 100 million people in the world probably own Bitcoin. And so out of 7 or 8 billion people, that's actually still a very small percentage. We're talking somewhere around 2% of the population owns some Bitcoin. And even if you narrow it down to smartphone owners, so that's about 4 billion, 4.5 billion people, somewhere around there, Bitcoin still is pretty early on in its adoption stage. And so when someone has a long-term view, I still think that these have long-term upside as long as you're not too concerned about near-term price action because they are volatile.
Speaking of near-term price action and then the long-term view, do you consider yourself as a part of the school of thought that I'm just gonna huddle onto this, or at a certain point, given that people take the halving cycles as references on the movement of Bitcoin, do you also consider selling at a certain point and then coming back in again when it's close to the next halving cycle, or I'll just huddle all the way, considering that it's still far from where it could possibly be and how valuable it is, comparing it as what you mentioned to the market cap of gold as well.
Basically, if it goes up at such a fast rate and reaches a surprising high price faster than I think, I could potentially sell into that if it becomes very euphoric. With the ideal that it's, for risk management, I might be able to buy more coins with the same amount of money later. And so I'm not, trying to time the market exactly, but if I do see a lot of euphoria, I would consider it. And so, for example, earlier this spring, when we started to see pretty much every coin was going vertical, right? So Dogecoin was going vertical, Ethereum Classic was going vertical. I warn my subscribers, like this is no longer a particularly healthy looking market. And so I didn't sell, but I was making sure they were aware of the risks. And so we eventually got that correction. Now, if you were to see an even like bigger, euphoric move, say next year, I would consider potentially trimming a little bit off the top. And that's more about risk management, making sure your allocation doesn't become too large of your portfolio, rather than trying to time the market precisely.
And when you say sell, you're parking it in stable coins or bringing it back to fiat?
I would essentially bring that back to fiat, but it depends on what the stable coin environment's like at that time. And so, for example, if you can get reasonable yields on your stable coin without taking too much risk, I think that's a reasonable type of diversification. In different parts of the world, we're seeing some more regulation pressure on some of these stable coins. And so I would certainly stick to the higher quality stable coins. And I wouldn't take on too much risk for that. But yeah, there's, especially if I expected a multi-year correction, I would consider pulling that back out in fiat going elsewhere. But again, that's only for a portion of my portfolio and only if it reaches, very euphoric levels that look like they're unsustainable for a multi-year period. Another thing I would point out is that I think, the halving cycle should become less important over time because, and it used to be that the mining supply of Bitcoin was a very large percentage of the existing supply. But as we've gone through a few halvings, that's now a very small percentage. It's a low inflation rate, in other words. And then we're actually starting to see an interesting dynamic now that miners have largely moved out of China and towards North America and other countries in the world. we've seen basically a change in how miners treat Bitcoin. And partially that's because the financial industry's kind of caught up a little bit. And so now there are specialized lenders. And so the cost of capital for mining is lower. They can get lower cost financing. So if you were trying to mine in China, for example, it's really hard to do it, right? You were kind of, you had uncertain regulations. There are not a lot of lenders that were specialized in lending to you. So they would give you very high rates, for example. But now that they've moved into North America, and some of them are public companies, publicly traded companies, they can access very cheap sources of capital. And so actually what we're seeing is that a number of the large miners that collectively probably own 20 or 30% of the hash rate over the next year are using a strategy where they just buy Bitcoin and hold it on their balance sheet. Like they mine Bitcoin, and hold it on their balance sheet. Some of them have actually also just bought additional Bitcoin to hold it. And so rather than mining it and then selling it to other buyers, that new supply just gets locked up in the miners. And so that actually potentially reduces the importance of the halving, because that's just Bitcoin that's kind of getting stuck on miner balance sheets. So that kind of comes down to what percentage of the mining industry is going to adopt that or not. So, I think longer term, these 4-year cycles will eventually become less important. But, the next one might still be important.
When Bitcoin started, the halving cycles were not really, there weren't really a lot of institutions into it. Right, fast forward a decade later, there's more institutions coming in. Does that have an impact also on the price, that it forms a relatively higher support level, giving the notion that more institutions are buying it at a higher price, thus somehow it could possibly support it there as well?
I think the long-term story is about adoption. So the more people that own it and the more institutions that own it, that keeps driving up the structural floor for the price. And so, if you kind of look at that long-term approach and then maybe consider, reducing your position slightly when you're way above that trend line. And everybody in the world wants to own Bitcoin right there. It's euphoric. It's gone up, 100% in a month. Trimming there it can be prudent. And at the same time, if Bitcoin has a big crash, if everyone says it's dead, and they think it's going to get worse and worse, that might be a time to put that capital back in. But I would advise people to be somewhat cautious with that, because this is potential asset that still has a ton of upside over the next decade. And I think the main thing is just to make sure you have some allocation to it rather than trying to be too clever. In addition, depending on where someone is in the world, they might have capital gains taxes that they pay on it. And so trading in and out of it can be a tax inefficient strategy compared to holding it for a decade or more. So it really kind of comes down to what the investor wants to do.
We're almost at the same age, and majority of the people watching this channel also are almost in the same age range as us. And the reason why I asked that is this: you mentioned about portfolio allocation. Given where you are and then how long you live still, where do you see a good allocation for people that they should expose themselves for cryptocurrencies? Especially if they're still young, they're productive, they also have different sources of income as well. So when you mentioned that I'm taking some out as part of diversifying my portfolio, how do you see crypto, Bitcoin, Ethereum to be part of that?
So I think it comes down more towards knowledge of the asset class than age. And so, for example, if someone is inexperienced or doesn't know the asset class very well, they can make poor decisions when it comes to buying and selling times. And so, for example, a lot of people, unfortunately, when Bitcoin reached over $60,000 a few months ago, there are people that bought in and then sold it when it crashed down to $40,000 or $30,000 because they thought, I made a mistake and it's, I bought it at the top and it's dead now. And of course, it's bounced back part of the way. But that's a tendency that can destroy a lot of capital. And so what I would say first is, my kind of default assumption, advice is basically, it's a good time to get off zero. So someone has no Bitcoin, they probably should have some Bitcoin, a few percent of their portfolio, and then really start learning about it. And then the more they learn about it, that can adjust them. And say they learn some things and they don't, maybe it doesn't really click for them, they might not want to increase their allocation. On the other hand, the more they read, if they like the technology, they think it makes sense to them, they know the history of it, they know why certain decisions were made. So what makes why is Bitcoin the way it is? Why are the block sizes the way they are? Why is Why are all the technical specifications how they are? Why, because those are pretty deliberate decisions. So the more that one is familiar with it and knows the signs to watch for in terms of adoption, they could consider increasing their allocation pretty significantly if they're willing to take that volatility. And I would be careful with some of the smaller coins. And so, for example, I think the main one to hold is Bitcoin. Ethereum is also, it's a large capitalization. That one has some upside potential as well, especially like we talked about, in this kind of current environment of ETH2 locking up some of the coins. But once you go into the smaller coins, it's important to be aware that, there are over 10,000 cryptocurrencies. And so most of the popular cryptocurrencies in any one cycle, they're not tend to be the ones that survive the next cycle, right? So Bitcoin's the one that's gotten through all cycles. We've also seen Ethereum do reasonably well for 2 cycles now. But most of the poppers, the ones that came out, almost a decade ago, no one hears about now. The ones that really popular in 2017, other than, again, Bitcoin and Ethereum, most of those are not very popular. The ones that are popular in 2021 are quite different than the set that's popular in 2017. And so you have a very high probability of permanent capital loss if you allocate too heavily to these smaller tokens. So I would just advise caution before, putting a significant portfolio percentage in any of those smaller coins.
I want to go to the extreme side of this because there's still a lot of people who maybe they're not as knowledgeable enough or they haven't really done a deep dive, but there's a lot of talk that, at some point, this Bitcoin will go to zero. It's just all hype right now. It's just all everyone just coming into it, or we're just waiting for the last sucker to come in. What word of insight can you give people that Bitcoin won't go to zero? Because for people who are into crypto, when Bitcoin drops, they're just gonna stack, they're just gonna buy. But for a lot of people, it's time for them to panic or get out of their positions or not even invest at all.
Well, one thing I'd point out is that now it's 13 years old almost, and so bubbles don't generally last 13 years. I mean, there are some that can last a very long time, but it's clear that we have a novel technology here at the very least, and so it's gone through multiple 80% plus corrections. In some cases, I think 90%, and it managed not to die. And so at this point, the probability is on the side of Bitcoin keep going up for a long period of time. Again, like I said before, somewhere around 2% of the world owns it, which is still a very small percentage. It's a fraction of 1% of global assets. So banks like Credit Suisse estimate that there are well over $500 trillion worth of assets in the world, and so if 1 trillion's in Bitcoin, you're talking about a fraction of 1%. It's a rounding error in terms of global where money is. And so this is actually still a very new field that most people still don't have an allocation to. And so I don't really view it as a risk of something that too many people pile into and then it kind of rolls over. Now that can happen in the short term. We have that happen like, these cycles every 4 years or so. But longer term, something would have to structurally change about it in order to have that happen, I think. One way to look at it, people often think that crypto is speculation. And there's certainly, especially when you get into the smaller tokens, it does tend to be about speculation. That's part of why I avoid that space. But if you look at Bitcoin in particular, there are people that dollar cost average into it every day, right? That's not speculative behavior. They're treating it as their savings and they're ignoring the volatility. They're looking out 5 years, 10 years in the future, weighing the probabilities that will be worth more than their local currency that is, yielding below the inflation rate, and money supply is growing at a very quick rate. It obviously depends on what country you live in. Some countries have stronger currencies than others, but even the stronger ones right now are still yielding negative inflation-adjusted interest rates. And so when they can buy into something with a hard cap, 21 million, a lot of people are dollar cost averaging into that, and that creates kind of a permanent buying pressure. There are plenty of people that would buy Bitcoin, no matter what it does in terms of price. Millions of people like that. The only way I can imagine Bitcoin going to zero would be if some sort of like security issue happened, right? So it had in the very beginning, Bitcoin had an inflation bug that Satoshi fixed, which is its new technology. There was an unintended hard fork back in 2013 that was fixed, but at this point, it's a very kind of solidified code base at this point, and they're very cautious with their upgrade approach. It's a very conservative model. And so when you hear about things like exchanges being hacked, that's not Bitcoin itself being hacked. Those are custodians holding it. We also hear, for example, DeFi being hacked, right? So we just had, a $600 million DeFi hack. And again, that's not on Bitcoin. That's on these more experimental, newer technologies like Ethereum and Binance, Smart Chain, and things like that. Protocols that are running on top of those. And so Bitcoin really has stood the test of time in terms of being a very simple code base, and a very hard form of money. And so for people that don't mind volatility, I find the probability of it going to zero pretty low. But even then, I would say, you can do expected value, and say, okay, so there's a percent chance that for whatever reason, Bitcoin goes to zero. There's another percent chance that, it might not go to zero, but it stagnates. It just kind of, stays under $1 trillion market cap forever, right? It either fails to another cryptocurrency, or cryptocurrencies just start failing for whatever reason, and it just kind of becomes dead money. Then there's another, percent chance that it goes up 2, 3, 4 times from where it is now. And then there's another percent chance that it goes up 10 times or more. And again, that would still only be about as big as gold, which is, not remarkable to think about. And so there's, if you kind of do the expected value theorem of it and say, okay, there, we don't know the future, but I think that the math shows that it's a good asset to have some allocation to. It doesn't mean you have to bet your whole portfolio on it. You can put a few percent into it and just kind of put it aside for 5 years and see what it does, and kind of monitor it. Because one way or another, this is important technology. Even, for example, central bank digital currencies are inherently, kind of inspired by Satoshi's design. And so one way or another, this technology has, I think, profoundly changed money in the long term. And so I think, hopefully I'd like to see that Bitcoin stick around for the long term. I think it has a very good probability of doing so. But it shows that even if for whatever reason Bitcoin fails, that technology is pretty profound. That's going to be with us in different forms, probably, for the foreseeable future.
Seeing what's happening to Afghanistan and other areas where people's cash have been locked and they don't have access to it, I think it's what makes Bitcoin more relevant right now, that you have access to your money, that you can store it in a way that you can transfer it wherever you want to go. But you mentioned about risks as well and regulations. Of course, no government can shut down Bitcoin because it's pretty much decentralized, but they could block the off ramps for people to take it out from Bitcoin back to fiat. Do you think that would pose a risk as well?
It'd certainly be a risk in the near term, in the moderate term. And so that could create like a 2-year bear market, for example, especially if you saw it. Mainly if you saw that in the United States or Europe, because those are big sources of capital that could become skittish around Bitcoin. But another thing I'd point out is that normally when you see countries defend their currencies, right? So they try to block the exits, that often ends up being a currency you want out of, right? So healthy, strong currencies don't do that, right? Because they know that their currency can compete and they don't need to do capital controls and block it. The ones that start, making it hard to get out of that currency tend to be the ones that when you look back, a year or two in the future, didn't do very well. And so, if, for example, they blocked all the on-ramps and off-ramps in Nigeria, right? So they didn't make it illegal to own, but they blocked access to the financial system. And that continues to have a very robust trading environment, peer-to-peer trading. And so that was not able to kill the Nigerian interest in Bitcoin. And if anything, they arguably have the highest per capita adoption rate of Bitcoin in the world. They're at least in the top few countries. They might be number one, despite the fact that their on-ramps are blocked. And so because their competition is a currency that's inflating very quickly. And we also saw, for example, there were protests there against police violence and all sorts of things. And protesters had their bank accounts frozen in many cases. And so they started using Bitcoin to get around the fact that, they were being blocked from what they viewed as a right to protest, as a right to, be free. And so, it is really hard to really stop it long term. But I do think that if the United States or Europe did it, it would be a near-term headwind because those are just bigger sources of capital that would become skittish, especially, I mean, the one thing that would slow down certainly is the institutional adoption, right? So, it's hard to stop peer-to-peer trading, but you could make it so that larger pools of capital like pensions and endowments and hedge funds go into it more slowly. So I think that has somewhat lower barriers of entry. There's more competition there. And so that's one of the reasons I'm more concerned about Ethereum long term than I am about Bitcoin. And so if you compare Bitcoin to the other proof of work protocols, the ones that are trying to just be money, it's not even close. I mean, the biggest ones are like 2% of Bitcoin's market cap.